Good morning, traders. Steve Gans here, and I want to share a trade concept idea with you. Again, all these are always designed to be paper trade for educational purposes. But what I want to share with you today here, if we take a look at a chart on Apple, I want you to notice that Apple is somewhat coming into a resistance area right around here, right around this 235 range. It is pulling off it a little bit right now. It did have a huge run up over a couple days here, and I think it's probably a little bit tired at this point. And I'm thinking that it might get a little bit of back off, maybe back down to around this 220, 216 area, somewhere in there. So if I have that premise, how might I consider trading something like this with options? I've modeled up two different potential paths here to consider. One is a bear put spread. In this case, I am buying a 235 put, and then I am selling a 230 put. And that selling of that put basically keeps the buying power that's required for it under control. So in this case, I have a max potential loss of 245, max potential profit of 255, and a chance of profit around 53%. Now, another way that I could make this exact same trade, essentially, would be to sell a call spread. That's where I come in above the market and I sell a 230 call, and I sell it for around $8.20 or so. And then I buy a higher up call to protect my risk if the market rips up beyond my point. And I'm going to pay $5.50, $5.60 for that. So the same payoff is pretty much about the same. This is max loss 235, max profit 265. Here, max loss 240, max profit 260. Of course, these numbers are going to change a little bit as the bid-ask spread moves around on me. So it's important to note that many times with options trading, you can have two totally different trades, one using puts, one using calls, and they have essentially the same P&L diagram, the same profile. So in some cases, there is an obvious winner, why you would use one over another. For example, if the market were running up really hard, and we look back here at Apple on maybe this day right here, those calls would be bid up more at that point. So at that point, selling a short call spread probably would have been more beneficial than buying the put spread. But that's not always the case. The key is that when you have two trades that look very similar, model them both out. See if you're going to get a better deal on one, a better reward to risk ratio. So for our purposes here today, I'm going to save both of these. And I'm going to put this in the demo paper trades category. And I'm going to save that trade. And I'm going to copy the link. I will share it in the notes below. And then I'm going to do the same with the second trade here. I'm going to come in. I'm going to save this trade and put that also into the demo paper trades. And we'll save that. I'll put that in the notes below as well. And then anyone, whether you have an OptionStrat account or not, can pop these links open. You'll get exactly this look right here. And then you can go in and play with this trade yourself. You could go in and maybe model up something a little bit different if you think that it might warrant having a different profile on this potential paper trade. So with that, everyone, I hope you find this information useful. Please subscribe, give me a thumbs up. And of course, feel free to give me any comments if you like as well. Take care, everyone.